There's a number American car buyers used to whisper about. A monthly payment so heavy it sounded made up. $1,000 a month for a car. Today, 1 in 5 new car buyers signs exactly that deal. A record. And it's not a luxury story. The average payment across all new cars just hit $772. Also a record. And here's the other end of that same deal. Last year, 1.73 million cars were repossessed in America. The most since 2009, the depths of the financial crisis. Except this time, there's no crisis on the news. Just quiet driveways, one tow truck at a time. This is how the American car became a second mortgage, and how to make sure the next tow truck is never for you. Start with the raw material. The average amount financed for a new vehicle just crossed $43,900, the highest ever recorded. Not the price, the loan. And while the loans get bigger, the down payments are getting smaller, down more than $600 in a year. Buyers aren't bringing less cash because they want to. They're bringing less because, after everything else in this economy we've covered in this series, there's less cash to bring. Run the average loan at the average new car rate, about 7%, stretched over the now standard 6 years, and you get $747 a month. Pay it faithfully, and that $44,000 car costs you nearly $54,000 on a good credit score. Now run it with the credit score of the people who can least afford it. Used car rates average over 10%. Subprime borrowers sign at 14, 18, even 21. Same car, $21,000 of pure interest. The less money you have, the more the car costs. That's not a glitch in the system, that is the system. But the payment isn't the trap. The trap is what happens when you try to get out. Because a car is the only thing most people ever finance that loses value faster than they pay it off. Right now, nearly 1 in 3 people trading in a car owes more on the loan than the car is worth. Underwater, and the average depth of that hole just hit $7,183. The deepest first quarter reading ever recorded, up 42% in 5 years. And at the dealership, that hole doesn't stop the sale. It gets 6 friendly words. We'll just roll that in. The old debt disappears into the new loan. A quarter of underwater buyers roll more than $10,000 of old car into the new one. Nearly 1 in 10 rolls more than 15. The result, buyers who roll negative equity pay $932 a month on average for a car that was underwater before it left the lot. Then 3 years later, they trade in again. Deeper. New car, old debt, bigger hole. Economists don't have a polite name for this. So let's use the honest one, a doom loop. Once you're in the loop, you're not buying cars anymore. You're renting debt with a car attached. So how much a strain can the loop take before it snaps? We're finding out in real time. Among subprime borrowers, the people who sign those 14 to 21% loans, more than 6% are now 60 days behind or worse. That is the highest rate ever recorded in 32 years of tracking. Worse than the dot-com bust. Worse than 2008. Total auto debt, $1.69 trillion, still climbing. And the tow trucks are catching up. 1.73 million repossessions in a single year. If you watched our Cash Poor Millionaire episode, you already know this shape. It's the K again. Prime borrowers, good credit, stable income, are fine. Their delinquencies are healthy and boring. The bottom half of the K is doing the drowning. The averages hide it. The repo statistics don't. And remember what losing a car means in most of America. Losing the way to work. The default doesn't just take the vehicle, it takes the income that was making every other payment. That's why auto loans are the debt economists watch as an early warning siren. The siren is on. Before the escape plan, one reframe, because the sticker price was never the price. A car costs you 4 ways: depreciation, the value quietly leaving every month; interest, the price of borrowing; insurance and fuel, the price of operating; and opportunity cost, what that money would have earned invested. The payment is just the visible layer. Personal finance veterans compress all of it into 3 numbers: 20, 4, 10. 20% down, so you start above water, not below it. 4 years maximum on the loan, If you need 72 or 84 months to afford the payment, the honest answer is you can't afford the car. And all car costs, payment, insurance, fuel, under 10% of your gross income. Now here's the uncomfortable punchline. On the median American household income, that 10% ceiling is about $670 a month, including insurance and fuel. The average new car payment alone is $772. The average deal on the average income already breaks the rule, which tells you everything about how normal this crisis has become. So 3 moves, whether you're in the loop already or one dealership visit away from it. Move 1. Tonight, look up what your car is actually worth, the honest trade-in value, not the fantasy listing, and compare it to your loan payoff. Above water, you have options. Below, you've measured the hole. Either way, you can't navigate what you haven't measured. Sound familiar? It's the accessible number audit on wheels. Move 2. Refuse the 6 friendly words. Never, never roll negative equity into a new loan. If you're underwater, the escape is unglamorous. Keep the car, keep paying, and let the loan catch up to the value. Boring beats drowning. The doom loop only works if you keep feeding it a new car every 3 years. Move 3. When you do buy, remember the dealership sells payments, not prices. Stretching the term makes any car affordable, the way cutting a pizza into more slices makes more pizza. Negotiate the total price. Apply 24/10. And if the numbers only work at 72 months, walk. The best car payment is a smaller one. The perfect car payment, once the loan is done, is the one you keep making to your own savings account. Cars will always cost money. They never have to cost your future. A record share of buyers pays $1,000 a month. A record share trades in underwater. A 32-year record can't pay at all. The quiet crisis is only quiet if nobody says the numbers out loud. Now you can. Next on the Illusion Files. Every month at exactly 8:30 in the morning, the government publishes the one number that decides whether your raise was real. The next release is days away, and we'll break it down the same afternoon it drops. Subscribe so you don't miss it. See you there.